Good day, and thanks for joining us for our webinar on the 2018 Crop Outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today on our webinar are Chris Hurt, who's a professor of agricultural economics and a longtime market analyst, and Michael Langemeier, who is also a professor of ag economics and associate director of the Center for Commercial Agriculture. So we're going to talk about the outlook, and it's particularly timely because just yesterday USDA released its planting intentions report, which gives us some updated information about what's likely to take place here in 2018. So let's take a quick look at what we plan to cover today. We're going to summarize some of the information from USDA because they've released not only the planting intentions but also updated stocks estimates. Take a look at some crop budgets and particularly look at break-evens for corn and soybeans here in the Corn Belt. And then discuss where we think we're headed with respect to the outlook and maybe make some concluding comments about the farm economic setting and some strategies you might think about. So with that, Chris, let's kind of take a look here at the stock situation because that was a little bit of a surprise, I think, certainly to me and I think to most people in the marketplace.
Well, it was. And again, we had a little bit of a bearish tone, I think, on both corn and soybeans on the stocks report. First, looking at corn, the numbers there were almost 9 billion bushels of corn in inventory on March 1st. The trade's expectation was lower than that, so actually about 175 million more bushels of corn than what the trade had been expecting. Soybeans, similar pattern, 2.1 billion bushels of soybeans on March 1, still in the grain bins. Trade didn't expect it to be quite that high, so about 65 million bushel number higher than expectations. So when we take those, how might USDA adjust their balance sheet, their supply and use information? First on corn, that 175 million bushels probably leads us to believe that perhaps USDA will reduce the feed usage. Remember, it's feed and residual. So when you have errors in your total balance sheet, those show up in the residual category. So if we have more corn out there, maybe one of the things that's going on is we're feeding less of that corn. So I think there's a possibility they could drop feed usage in their next update. That's going to increase the carryout more than likely. But again, as we look at the balance sheet, we're going to talk about corn. We've got really good use on the export side, really good use on the ethanol side. So we've got a lot of strength in the corn demand side. On soybeans, similar direction. What would USDA do to make adjustments because we have more beans than what was expected? One of the things they could do would be to lower exports, but exports, we have pretty good numbers, data on the exports. We actually track those week to week, and then the Census Bureau has official estimates, official numbers actually on the beans that are exported. So more than likely, they could reduce exports a little bit or just leave their balance sheet unchanged and say that maybe this is reflecting that our usage is off a bit or that the crop last year was actually bigger. Now we'll have to get all the way through the marketing year before USDA has enough information to say if that's the case or not. Wheat was quite neutral, came out just like the anticipation. But if you just looked at these numbers, I think we would have said, corn will be off 2 to 3 cents on the stock numbers, soybeans probably 3 to 5 cents. So they're a little touch bearish.
So that was the bearish news. And just as a point of clarification, Chris, USDA released an updated grain stocks estimates yesterday. They did not release updated world ag supply demand estimates. Those will come out here in early April.
That's correct.
Which is why we're kind of speculating on what USDA will do with those updated supply demand estimates.
And obviously that's what the market has to do. The market has to trade all the information. So yesterday would have been talking about and discussing how will USDA make adjustments.
So let's move on to the other big news yesterday.
The fun part of yesterday's
the fun
news.
part with the positive surprise was on the acreage side because the acreage numbers came in a little bit under what people were expecting on both corn and beans.
That's right. Did we skip a slide there? See if we go back one.
I didn't think so.
No? Okay. All right.
It's this one.
Okay. Then we have the actual numbers. Little historic sketch here going back to 1996. Why 96? That's the first year of freedom to farm. So that's when we really got out of the government in supply management and let the market determine acreage. Let's pick up about the middle of the graph and see up at the top line, that is corn acreage in the United States and planted acreage. And you see the surge in planted acreage starting from about the middle 07, 08, going up to 2012. That's the ethanol boom. So we had to get acreage in place to meet that new demand for ethanol. But since 2012, basically corn acreage overall has been headed down. The report yesterday said farmers intend to plant 88 million acres, and that was about 1 million acres less than what the trade had expected. Of course, the real surprise came on soybeans. Soybean acreage at 89 million acres. That's kind of the pinkish purplish line. And that was 2 million acres less than expected. So there's where you really got the surprise, the bullish surprise, particularly on soybeans, with 2 million less acres of soybeans. Now, I think the other point we've made many times, and that is look at the growth of the soybean acreage, 74 million acres back in 2012, advancing to 89 million acres, 15 million acre increase just since 2012. What is driving that? Well, what's driving that's called China, the increase in their soybean purchases. And for the 18 crop going into 19, USDA is looking for another 3% expansion in the total imports going to China. So as we look at corn use, we look at the soybean use over time. Soybeans are probably, we anticipate, going to have a higher growth rate. And this phenomena of seeing more acres of soybeans than corn in the United States could become more of a standard rather than an unusual situation.
Michael, I think you took a quick look at the states to ascertain where did the acreage shift occur and where did it occur?
The largest declines in corn acreage was Minnesota, North Dakota, and Kansas. In fact, 1.5 million acres was 1.5 million acres was dropped compared to last year for corn acres in those three states.
So a big shift in some states that we don't really consider typically the core of the corn
belt. And those acres appear, at least for Minnesota and North Dakota, to be going to spring wheat. Kansas it's more complicated than that because they have winter wheat, of course, but certainly it looks like a switch from corn to spring wheat for about 1 million acres in Minnesota and North Dakota.
And then I think you looked a little closer to home here in Indiana. We've got a shift, kind of a long-term shift taking place in Indiana.
Yeah, it was a bit surprising, I think. We're up, the planting intentions are 6.1 million acres of soybeans and 5.1 million acres of corn. That's unprecedented to have a 1 million acre difference between soybeans and corn in favor of soybeans.
Here in Indiana.
And here in Indiana.
Can we learn to say beans are king?
And the largest increase in soybean acres actually occurred in Indiana. If you look at all the states, it's at 150,000 acre increase compared to last year.
And you've been talking about this for some time with respect to the relative profitability of soybeans versus corn here in Indiana.
Yeah, definitely. Since 2014, it's been a definite advantage to soybeans in the tune of about $50 to $75, depending on the year.
Yeah.
And that's per acre.
Per acre.
$50 to $75 per acre. Wow.
Well, Chris, let's take a look at the balance sheet, at least our expectations for what might happen when USDA releases updated numbers here in about 10 days.
Yeah, so looking at the acreage in aggregate across the country, start with those reductions in corn and soybean acres from last year. And again, where did those acres come from? As we look on down the table there in the blue background, you'll see it came from wheat, and Michael's already mentioned that. And I think something kind of significant is to say that why are they shifting to wheat? Well, it's been the other way for a number of years. It is the concern about the yields in the central and southern plains, the weather, the dryness, the drouthy conditions there that has raised expectations on price. And simply what we're seeing is on spring wheat, better profit opportunities on spring wheat up in the northern Great Plains, and that's one of the shifts we're seeing. Now, another shift we're seeing is cotton acreage, and we look at the south, both cotton and rice acreage are up pretty substantially, and so that's coming out of corn and soybeans. So I think one of the changes we see here is that there are some other crops that are more profitable than our two core crops of corn and soybeans. We haven't been able to say this much in the last several years. Some other crops are drawing away acreage from corn and soybeans. So I think, again, it's a beginning of a sign that there's an improvement in the overall balances and price opportunities and profitability beginning to show up in some of these crops. Total acreage, at least of these 9 major crops, very much down at the bottom there, we're only down about 700 million acres. 700,000 acres, 700,000 acres. So what that's telling us is that most of the land that was planted last year is going to be planted this year, that these numbers do add up. The total acreage base does add up pretty close to what last year's total acreage base was. It's just that we have shifted around and unusually shifted out of both corn and soybeans.
Yeah, that was the unusual part. And then I think the related point, Chris, is on your next slide. Let's take a look at that real quick. You've looked at the long-term trend here with respect to planted acreage to the 17 so-called major crops plus CRP plus hay crops. And that trend is really interesting over the last 2 decades.
Well, that's right. And again, what we're trying to get a sense of is the total cropping base in the United States. So this includes most all of the crops that have any measurable acreage, as well as CRP and the hay land. And we go back to 96 again after Freedom to Farm. And the trend is pretty easy to figure out there, I think, and that is overall down. And as you look at that regression equation up there at the top, you see 918,000 acres a year. That's about 1 million acres on trend over this fairly long time period that we've seen our total acreage base go down. Now, I think we'd argue this is primarily urbanization that's going on. It may be lost to parks, a few other uses, but primarily as our cities and urban areas grow and highways grow, et cetera, we lose some of that crop land. Some other interesting points, particularly thinking about the acreage here in 2018, and did USDA find all the acres out there, is that looks quite consistent with where we've been the last 3 or 4 years, with a slight decrease each of those years. And the other thing I think we can see from this visual is that there is some land that can come into production or go out of production. Look in the middle of the graph. Starting in about 05, 06, 7, 8, 9, we kind of see a surge in that first boom that we saw in prices of grains getting higher. We brought some additional acreage into production. And then we had the 2009 recession that lagged into 10, and we saw our acreage come down again. And then we had the second boom in grain prices in 2011 and 12, reaching highs in 12. And we surged acreage again above the trend line, but then in 14, 15, 16, 17, we've brought that back down. So I would say we probably have taken, there's discouragement has taken some of the land out. That adjustment has occurred. We're now looking at the acreage that seems pretty consistent, and being a little bit below the trend line there, I think says that USDA's numbers are fairly realistic. They probably do have the total acreage base pretty well in mind. But over time, 1 million acres a year doesn't seem like a lot, but over 20 years, you're looking at 20 plus million acres in the United States coming out of crop production.
Chris, the other thing I think people have been talking about in advance of this report, 2 reports yesterday, is what's taking place in South America. And you've taken a look at that with respect to expected changes, at least at the moment, with respect to production in Argentina and Brazil.
Yeah, this is obviously an ongoing story that the marketplace and market intelligence continues to try to sort through. And USDA certainly is one of the parties that is trying to estimate the size of those crops. And what we're going to look at here is both corn and beans, corn over on the left, but we're going to go back to December, basically more the start of the production year in South America. And we're going to look at first USDA, what were they estimating the size of corn production in, this is Brazil and Argentina added together. And then what is the most recent update, which was done in early March for USDA. They've reduced the corn crop about 256 million bushels. If you look at private estimates that are coming out from various individuals and organizations in South America that are making estimates, those are closer to pushing up to around 374, 400 million bushels. So we don't know. This is an ongoing story. How big will those reductions be? Clearly a driving force, especially for the bean market, but also important for the corn market. Or on the right-hand side, the two bars are reflecting soybeans. USDA has reduced their production estimate by 200 million bushels since December, the start of the growing season there. Private forecasts are considerably lower than that, and we think USDA will be lowering their estimates on production in their April updates, but those are closer to 400 million bushels. Now, why is that important? Well, that's important because the soybean meal and oil coming out of Argentina that is not going to come out because the smaller crop, probably that demand is going to go someplace else. That's primarily Brazil and the United States. USDA has not changed their anticipation much, so I think they still have an opportunity, USDA, to increase the amount of especially soybean meal exports we have from the United States. So this continues to be an ongoing story. It's part of what we don't have the answer to at this particular point.
Yeah, and I think what that really means is when the next round of WASDE reports from USDA come out, people are going to look very closely at those world stock-to-use ratios, which are tightening. And the data you've got on the screen there suggests tightening more than what we thought a few weeks ago.
I think the direction we would talk about. The market is anticipating how big. So the marketplace is more looking at these private numbers, would be my guess at this point. Another point on Argentina is that how long can dry weather continue to reduce yields? Well, they're at the end of their growing season now. Generally, we expect at the end of March, their growing season's pretty well over. So can there be additional damage? Probably not. How big is that damage? Still to be determined.
Yeah, good point. So the other big story, of course, has been trade and possible impacts on perhaps a retaliation with respect to ag trade here. And you've taken a look at a huge source of demand, particularly for soybeans, with respect to China, and look at that on both the soybean side and the pork side. So let's talk about that.
Yeah, so we saw a month ago peak in soybean prices, and then got into these trade issues, and obviously soybeans could be front and center in trade issues with retaliation from China because they buy so many soybeans from the United States. So one of the points that I think we want to make is that China needs our soybeans. China is not likely to stop buying beans from the United States. If they put tariffs on those soybeans from the United States, it would raise U.S. prices, but they're still going to have to buy beans from the United States. Unfortunately, over time, if those tariffs stayed in place, Brazil, Argentina, and other producers could respond and produce more of the beans. It puts us into a residual supplier standpoint. We want to be preferential suppliers. We don't want to be residual suppliers. So obviously agriculture is going to do everything it can. But let's just look at the numbers in the top cell of this visual and go over to the right-hand side, and that's saying it's China's total soybean use is 100%. Where is the origin? Where do those beans come from? This is 2017 data. Well, Chinese produce 13% of their own soybeans. So very little of the beans they use come from their own production. United States exports or imports from the United States were 29%, near 30% of all the beans they use. And then imports from the rest of the world, other than the United States, about 59 or 60%. So obviously, they have to have the beans from the United States. So that makes them more hesitant to put restrictions on those trade flows. And if they did put restrictions like tariffs, that doesn't mean that our sales of soybeans to China drop by half or 60%. It probably would go down, but they still need the beans. Now, contrast to that is pork, and China has talked about a retaliation of 25% tariff on pork. And let's look how different in the bottom cell pork is. Again, thinking about 100% of their use in China, Where does that pork come from? Well, 97% of it is produced in China. It's domestic production. 1% is imported from the United States and 2% from the rest of the world. And that 1% for China is so small, they can easily buy that from other countries like in the European Union or Canada. So much different situations on corn and soybeans. But obviously trade is a big part, trade concerns and trade restrictions are a big part of what's been in this market as well.
And I think the other point, Chris, is you kind of highlighted this a little bit, but maybe revisit a little. With respect to soybeans, in the short run, China would still have to come to the U.S. to buy beans, but the real concern there is perhaps more of a long-run concern in terms of stimulating production elsewhere and making the U.S. a longer-term, smaller supplier as opposed to a longer-term, larger supplier.
Yeah, and I think the long-term impact is really the scary impact. But there have been short-term impacts. We've heard in the marketplace that Chinese buyers have asked U.S. suppliers to put some kind of a clause in current contracts that if there is a tariff, that the Chinese could cancel the contracts. Again, U.S. suppliers, grain companies, are not likely to be willing to put that kind of a statement in a clause. So I think even in the short run, we probably have some implications that if the Chinese can buy from Brazil and Argentina without the worry of some kind of trade restriction, that they have a little more incentive even in the short run.
Yeah.
So we need to work on this, and obviously agriculture understands that very clearly, that this is a real threat, and we have to do everything we can to try to avoid conflicts on the trade side.
And in the long run, Jim, Brazil and Argentina could still have some acres that they could add and produce more soybeans. You're talking to people down there, but also the former Soviet Union. They could expand their soybean acres. They've expanded corn and wheat quite a bit in recent years. They could also add soybean acres, and so there's some real threats of some added acreage elsewhere if we have tariffs on U.S. soybeans.
And that's the clause I've been saying is we want to be a preferential supplier.
Yes.
We want them to come to us first. We don't want to be the residual, that they come to the United States to just buy the last of what they need.
Good point. So let's talk about prices a little bit, Chris. You've looked at the marketing year average prices, both historically, and then used the futures market to estimate what the market is effectively forecasting for the next several years.
Yeah, we go back to 2012, of course, a drought year, but also tight stocks. Those are record high prices. So we're looking both at the record highs and we're looking at this time period, when are the lows? The yellow shaded background is at least the information we have here, is the low price year. And that currently still stands with the 2017 crop that we're in the process of marketing now. USDA still has a $3.35 estimate on that. Now, with the rally we've had in current prices, we still have through August of this marketing year, those numbers are probably going to be higher, and actually the 16 crop is probably going to end up being the low price year. But let's follow along on corn as we look at the 18 crop. That's the one we'd be planting this spring. Going out to futures prices yesterday afternoon at the close, adjusting those back to a basis reflecting the U.S. average price or marketing year average price. That gets us up, corn prices up around $3.95, pushing towards $4 a bushel. And then that's pretty consistent going out to the 19 futures and the 20 futures. So moving up pretty quickly with this 18 crop to the higher $3 range, then holding around $4. See a little different pattern on the soybeans. Lowest prices already made back in the 2015 crop. USDA is at $9.30, and again, that's probably going to be revised upward somewhat as we market some beans at a little higher prices as we go through the rest of this marketing year. But the shortage of beans in Argentina really driving up nearby prices for that 18 crop, over $10 being reflected now for a marketing year average price. But what we see going forward in the futures market in the out years, 19 and 20, is that this continual idea that Michael's been talking about, Bean returns look stronger, and that's true around the world. That draws more acreage over the next several years into beans, and it gives us an opportunity for corn prices to recover and stay stronger, and those wheat prices to get back to $5 and stay around $5, but with some flattening or lower prices of soybeans going on out into the future.
So, Chris, we've been talking about this for several years now with respect to the fact that we'd entered into a new environment starting in that 2013, perhaps 2014 era. Looking at the prices on the chart, those peak prices were in 2012. We had a long-term downtrend in prices, and now we're suggesting that 16, 17 might turn out to be the bottom, and seeing some strengthening on the right-hand side. So a little bit of a ray of hope in terms of looking at some prices that are actually pretty close to our break-evens.
Well, and we not only know these prices adjusted to the downside substantially in the last 5 years, but we also know that producers responded by really working on their cost structure. So we want to hear from Michael what he's thinking about cost. Are we at a turning point where we're going to see some change on the cost structure as well?
We'll do that in a minute. So let's take a look at the actual balance sheet, and then we'll take a look at those break-evens.
Start with the 17-18 marketing year we're in right now, marketing the 17 crop. I dropped the feed and residual 50 million bushels. Again, this is because of the 175 million bushel higher stocks number. Best guess is USDA will take some of that out of feed and residual use, and that will add to the carryout down at the bottom, the 2.177 billion bushels. Then carrying that 2.177 into the 18 crop on the right-hand side, and here we get to the magic of higher prices, and it's not magic at all, it is the production. Production number for 2018 with 81 million harvested acres. I'm using a 173.5 bushels per acre for a U.S. average price, and that drops production to a little over 14 billion bushels from 14.6. So we're looking at 550 million less bushels of production. So those are huge numbers, and then go right down to the ending stocks, and you see ending stocks drop by 600 to 700 million bushels. So that cleans up a lot of our surplus problem if we have normal yields this year. I've left usage pretty much unchanged. Total usage from the 18 crop, about 14.8, very similar to the 17 crop. And there's the strength in prices that we get there. So we start to get substantially lower carryover numbers. Now again, as we go through the next several weeks, we'll see how corn and soybean prices adjust. Will corn attract a few more acres? We have to remember the government does an intentions report. Farmers are reporting what they intend to plant. Does that mean that's what they will plant? There's still time for some adjustment. And again, this really does change from a surplus situation to a much more acceptable level, I think. The other thing that we can talk about with the corn balance sheet, you get down to 1.5 billion bushels of carryout, weather becomes a more interesting issue. Some harmful weather someplace in the United States can easily trim 200 million, 300 million bushels, and then you get a more bullish scenario popping up real quickly. Now, I put a price personally of $3.85 for a U.S. average price next year. That would be a little bit below what futures markets were suggesting at the close yesterday afternoon.
So let's take a look at those ending stocks relative to usage for both corn and soybeans here in the U.S., and that's really a pretty interesting chart, Chris.
I think so, and it's reflecting some change that we've already started to talk about. And let's start with the blue line. That's the corn ending stocks as a percent of use. And if you go back to 2012, the blue line, we had the lowest inventories, the tightest situation, stocks to use. And then we go 1, 2, 3, 4 years of seeing increasing inventory. How do you get increasing inventory? You produce more bushels than you consume. You do that for 4 years, you build inventory, build inventory, build inventory, build inventory. Then we see a change starting with the 17 crop and now the 18 crop movement to lower inventory. So this is a fundamental change in the overall supply-demand situation. We now have expected to have, with the projections for 2018 crop, we expect to have our second year in a row where U.S. production has been less than use. We're starting to reduce those inventories. Soybeans are the red line, and you see there we had about 5 years, 4 years, 14, 15, 16, and 17, of increasing stocks, producing more annually than we consumed, and we finally see the beginning of the turnaround for the projections currently on the 2018 crop, where we start to reduce those inventories. One of our professors that worked in the international trade area used to say, when you look at the world inventories, the first year, if you have 1 year of reduction of inventory stocks, you'll begin to increase prices. But if you get 2 years, 2 consecutive years of reducing those stocks, that's when you get more encouragement to prices to the upside. I didn't mention wheat. It's pretty dominant on that chart, the green line. But again, we're in our second year of reducing inventory. And this suggests that we're in a period of better price opportunities and maybe also helping us shift to a better margin situation, at least beginning of a better margin situation.
Yeah, and we're showing those, we're showing those declines here in the U.S., but those are exacerbated by the fact that things are tightening up on a worldwide basis.
And in the world, this will be our second year in soybeans of having lower stocks. So again, we're seeing progress. And, as the old saying that Earl Butz used to say, low prices are the cure for low prices. It takes time, but low prices do build usage over time.
So let's take a look at a couple of price charts. So this is July corn futures, and you've got some red lines on there. Let's talk about those.
Well, I guess the first thing to say is to look at that $4 price on the July futures. These are July this summer 18 futures, and all since last fall, go back to August, September last year, we traded under $4, and I think a lot of people looked at a chart like this through the winter and they said, if we ever get back to $4 again on new crop corn, or excuse me, this is July corn, I'm going to sell, I'm going to clean out the bins. We did see a lot of selling on that rally according to the grain buyers I visited with. Then the last 2 to 3 weeks, we got into the trade issues. We backed off to about 380. And what a remarkable day yesterday to almost get back to that $4 mark again. So I think anybody that has kicked themselves because they didn't sell as much old crop corn as they wanted, as they wished they had sold after we dropped back from that $4, opportunities knocking again, or at least was yesterday afternoon. Now again, if we could go through that $4 mark, you can see some of the history back in last summer, the highs with the weather scare we had in the Eastern Corn Belt, 420 to 430 prices on July. So that appears to me to be kind of the optimum until we get into actual plantings and then get in to see what the weather really looks like for the United States and the Northern Hemisphere. So again, the line I've used as I knock on a wooden table, say, what's that sound? Opportunity knocking. It came back again after these reports. So I think, again, we encourage people to really look at additional sales on old crop, or if they said, I wish I'd sold more, here's the opportunity, knock, knock, knock.
And Chris, we've got a similar opportunity looking at us with respect to new crop as well.
Absolutely, and probably a little more bullish pattern here on the new crop. Well, that's where it should be. It was the acreage number being so low on corn as well as on beans that really was the driving bullish force after the reports. But you can see that level of about 410 to 412 a bushel, retesting that level peak that we were at a couple of weeks ago. So adding to new crop sales, I think, would certainly be the recommendation. Probably will take some other weather problems to get us on up in that 420 to 430 range, but those are achievable kind of prices now. But I think there's a lot of support at that sell-off price here last week at about $3.90 on the new crop. So we've increased our support level. We have good opportunities right now, and with a little optimism that perhaps we could test another 20, 30 cents higher.
So Michael, let's take a look at the break-evens, right? You've done some updated budgets, so these are the current break-evens.
Yeah, let's talk a little bit about what the blue and the red bars actually represent here. The blue bars are variable cost items, and so those are your fertilizer, seed, repairs, chemicals, operating interest, crop insurance, general insurance, fuel, these kinds of things. And then the red bars have the variable cost plus machinery ownership costs, land costs, and labor costs. And so the red bars are full costing. And so I want to make sure I did note that. If we were paying attention, which I'm sure you were, back when Chris was talking about prices since 2012, this is a much different situation than what we were in 2014. In 2014, the price had already come down below $4 for corn, and our break even on the high productivity was still at $4.50. And in some cases even higher. We're in a much different situation as we're looking at 2018, moving into 2019, 2020. Now we're starting to see that convergence between the break-even price and the corn price, and we're very close on the high productivity. Given the prices that Chris was talking about earlier, we're very close to a break-even level using the future price close yesterday. Whether they'll stay that high, we'll wait and see. But right now we're close to break-even on for corn, and just to reiterate, that's been quite a while since we've been there, probably 2013, and so that's certainly good news.
So really two things driving that, right? We've made some progress with respect to reducing some of the cost of the inputs. But the other factor, which maybe we should highlight, is the fact that on a trend line basis, corn yields continue to go up, right? So we're dividing by a somewhat larger number of bushels, and that makes a big difference over time.
And I should point out, this is with trend yields. If we have above average yields in 2018, like we've seen for the last 4 years, the break even won't be $4 for corn. It'll be $3.75 or something in that range. And so a very good point, Jim. That's really helped us on the margin side, particularly in 16, 17. The relatively high corn yields in the Corn Belt has really helped corn margins.
Just point out also that we just talked about December futures around 410 after the report was out. And we said, a shot, maybe we get up to 430. Probably an Indiana average price might be close on average, marking your average price to that December price. If we got that other 20 cents, that'd give us 430. That about breaks even.
Yeah.
Gives you near break even for the average quality land.
Yeah, good point.
Good point.
So sort of knock, knock, knock.
Yeah.
Here's some opportunity looking us in the eye right now.
So let's just kind of wrap up on the corn side. Chris?
Sure. Old crop inventories obviously are still going to probably increase. That is the stocks report telling us there's more out there, more grain out there, and they'll probably reduce the feed use. Remember, old crop inventory is abundant. It's not like we're going to run out of old crop corn. There's still lots of piles out there. We're going to have 2.1 to 2.2 billion bushels of carryout. And what's bullish is coming in the 18 crop. If we reduce yields, we reduce acreage, that's where you start to get the bullishness. Now that brings up the 2017 crop prices as well. But remember, there's plenty of old crop corn. Lower acreage and lower yields in 18, we've talked about that. There's those July futures, maybe 410 to 430. I think Michael's going to tell us beans are still more favorable, even with this big rally we had yesterday. Beans still are more favorable. So still some planting decisions to be made on corn and soybeans. And we really tighten up the stocks next year with the 18 crop. And we've made the point, Jim, that weather then becomes a bigger potential bull market when we bring down the anticipated with normal yields to 1.5, 1.6 billion bushels of corn carryout. And we're not just talking about 1 year of getting higher prices. We're looking at a foundation of better prices for several years to come.
Yeah, and I guess looking at that last point, Chris, it's really a little bit of a paradigm shift. We've been talking for the last several years, you mentioned, especially in that 13-14 environment, when we started looking at this long-term decline as we were building stocks across the board, not only in the U.S. but around the world. Now we're looking at a different environment. We're tightening those stock numbers in the U.S. We're tightening those stock numbers on a worldwide basis. And that creates the potential for a different environment. Right. It doesn't guarantee that we're going to have a big rally over the course of the summer. We're not really saying that. But we are saying it's a different environment. And that means from a marketing standpoint, you need to think about that a little differently in terms of when you do lock in some prices, if you're worried about the risk that prices might increase substantially, maybe this is an environment to think about using some options, some call option strategies to protect. That might give you a little more incentive and a little more of a courage, if you will, to make some of those sales here in the spring. So think about some of those things because it's a different environment than we were looking at really these last 3 years.
Well, I think that's right. And again, if you're in a period of overall downward prices, it's better to sell early than it is to wait and longer. When you're in a period of maybe a bit of positive tone to prices, then you have a little more incentive to wait till tomorrow to price or wait till a little bit longer or storage as well. So a lot to think about in all that.
Let's take a look at the soybean side, Chris.
Well, not as much drama here, I think, in reducing inventories, at least as I would project out. As we said, stocks numbers were 65 million more bushels of beans than had been anticipated, at least by the trade. So I dropped exports by 30 million bushels, put all of that into higher ending stocks, carried those ending stocks 585 million bushels over into the 18 crop. And here we see production numbers then with 88.2 million acres harvested, 48 bushels to the acre, that 4.234 billion bushels. So a reduction from last year, 160 million bushel reduction, but not as dramatic as what we see on corn. Again, I've got higher total use on soybeans, anticipating that exports will rebound as we pick up more business of the reduced Argentinian crop and we sell more beans into the world. And I've got that carryout dropping to 469 million bushels from 585 this year. So that is certainly an improvement. It's not as dramatic of improvement, I think, as we see on corn. So I've got bean prices higher at $9.75 a bushel. Again, U.S. average price or marketing year average price. But I'm not as optimistic, I guess, as what futures are trading more like $10.50 in terms of futures prices. So improvement on the beans, first year of starting to bring our inventories down, and overall a turn to somewhat higher prices, but maybe not as strongly higher relative to corn.
Let's take a look at the price charts.
Okay, so there's the old crop rally. This is July futures. 3-4 weeks ago, peaked out around the 1080 mark, sold off to 1020. Again, I'm sure a lot of producers that didn't sell all of their beans were kicking themselves, and so yesterday we did have a strong recovery back up towards that 1060 level. So I think this gives a second opportunity to be pricing soybeans at levels that are well above the $10 mark on the old crop. Can we go up and take out that 1080 or so high? Well, that's still to be determined. How much loss do we have in South America? What will be the planted numbers? And again, are we going to get into trade disputes with China? Because if you want to get into billion-dollar crops or products, you have to get to soybeans. So we sold soybeans last year to China, about $12.3 billion of soybeans to China. If President Trump is talking about $50 to $60 billion of sanctions, an equivalent number has to be something pretty big that China comes back with and talks about in retaliation. In agriculture, it would be beans very quickly they'd talk about. So I think that's going to hang over the market here for a bit. We hope cool heads will prevail and we'll get through this trade potential crisis. But still lots of uncertainties that could give us downside is the point of that. I like $10+ cash beans.
Let's take a look at the new
crop. Retested the highs, again, this 1050 level. So we're looking at 10 10.25 beans out of the field. A retest of those highs, we'd say the same exact things. You've had second opportunity here to get started on your new crop sales, or maybe add a little bit to those new crop sales. And again, will $10+ beans pay the bills? And I guess Michael can tell us that.
What a timely segue.
Yes, it depends on the soil productivity. Certainly, when you're looking at the higher productivity soils, definitely we're looking at about a $10 break-even price there, which is down about 75 cents to $1 compared to 2014. And so, just like corn, we've come down a long ways on the soybean break-even prices. If you look at equivalent break-evens here in terms of profitability, think $4 corn and $10 soybeans. We'll come back to that on another table here in a little bit. And so it just depends. The relative profitability here really depends on where corn and soybean prices are, what they're expected to do next fall. If corn is around $4 and beans around $10, we're looking at similar profitability. If for some reason beans are a little higher than $10 and beans and corn a little lower than $4, then we look at advantage towards soybeans. And so the reason I bring this up and keep reiterating this is a different situation that we've seen compared to the last couple years, where it was very, very clear that there was a $50 to $100 difference in the profitability between soybeans and corn in favor of soybeans. And so, given the recent prices that we've been talking about here, and the recent price changes in the futures, it looks like they're coming together and have similar profitability. Time will tell.
Yeah, and I was just going to throw out, as we look at this cash pricing opportunities, say $10.20 a bushel. A lot of our farmers in Indiana have on-farm storage. We have very strong amount of on-farm storage in Indiana, and they can add maybe 25 cents above their variable cost of storage, and so you're getting up $10.20 plus another 20 cents is $10.40, $10.50, where again we're getting back even to those average cost producers with some of their return from storage investment, getting back in these levels that they can price right now.
And when you're talking about 17 crop, the break-evens were much lower than what we're presenting here, because we had above average yields in Indiana and Illinois and several other states. And so you're looking at break-evens that are quite a bit lower than what I'm showing here. This is for 2018 crop trend yields.
Right. Which is the best estimate we've got at this point in time, right? So let's kind of summarize on the soybean side.
Yeah, we've sure hit the point that weather is still in play, obviously, in South America, and how will that impact their loss of yield, impact U.S. usage. At 65 million bushels, higher stocks leaves us scratching our head. Was last year's crop bigger? Are we going to have to add more to the carry-out? And I've added, as I showed you earlier, 30 million bushels on our balance sheets. Then the 18 acreage, USDA says farmers say down. Remember, that's an intention. And oftentimes in the marketplace, when we hear something from a report from USDA that is a surprise to the market, sometimes it doesn't end up being down as much. So let's be a little careful assuming bean acreage will be down that much. Yields probably down from these very good yields we've had if we get back to more normal yields. The new crop carryouts finally begin to come down with the 18 crop. We've signaled that as a fundamental change in the overall tone in the market. 1050 to 1080 futures, price some more, price some more, price some more. And again, that becomes your decision. Haven't talked weather too much yet, but does look like it will have wetness this spring in much of the Midwest, and especially again in the eastern corn belt. A wet spring could delay some corn planting, push more beans acres. So again, throw that out as a bit of a negative to prices. Cash prices above $10, let's give thanks because that has been a level that beans can pay some bills when you get above $10 cash. Longer term, what we see is some lower prices dropping back more in the $9.50 to $10 range. So while corn is stabilized and maintained, we see some weakness in terms of bean prices longer term.
Yeah. So, Michael, you've taken a look at some break-evens, and maybe let's look at that in a little more detail than we did previously. So you've looked at the rotation soybeans versus continuous corn. I'll let you kind of walk through this.
This assumes that corn acres were planted in 2017, so we're looking at break-even prices in 2018. And we don't need to spend a lot of time on this table. We'll spend more time on the next one because it compares rotation corn to continuous soybeans, which is more realistic in terms of the options. But as you can see here, with the soybean price of $10 on the high productivity soil, corn would have to be $4.34 or above to favor continuous corn. And so the fact that acreage is similar in this planting intention makes a lot of sense after you see this particular table. Let's look at the next one because that one's a little bit more interesting. Here, if we look at $10 soybean price, for example, and we look at high productivity, corn price would have to be $4 or above. Well, that's certainly in the cards. And so as I was saying earlier, the difference in profitability here really depends on what you expect corn and soybean prices to be this fall. If you do expect corn to be around $4 and soybeans around $10, it's a wash. Using the Indiana budgets, and you'd get a similar story in the data I've seen from Illinois, and so it really depends on where those fall prices land on whether it favors corn or soybeans.
And it also depends on looking at your own farm and your own records.
Yes.
What your track record is with respect to those yields.
That's why we've got the yields up there because, for example, in average productivity, you might get 53 bushel soybeans, but 180 bushel corn. That makes a lot of difference. And so make sure you take a look at your own yield comparisons between corn and soybeans and factor that in.
Now, Michael, you mentioned something earlier, that million more acres of beans in a state like Indiana than corn. That means there's going to be more beans on beans.
Yes.
So this is becoming more relevant for producers to think about what's the implication of beans on yield.
Yes.
Can you talk about that?
Last year there was 500,000 more acres of soybeans than corn. The planting intention says a million. The agronomists I talked to indicate that there's not much difference in the yield for second-year soybeans compared to first-year soybeans. You have to worry a little bit more about disease, and so there is some possible issues that could pop up. It's when you start looking at 3, 4, 5 years in a row of soybeans is where you really start to be concerned, and you're expecting a drop in yields compared to first and second-year soybeans when you have 3, 4, or 5
so
years.
So this is a new topic for us because 5 and 6 years ago we were building corn acreage. We're talking about 2 years of corn, 1 year of beans. Now we're going to see some that go to 2 years of beans and 1 year of corn.
We look at much more like Ohio. Ohio routinely has more soybeans than corn, and continuous soybeans are more common over there. Mm-hmm. Indiana is looking much more like Ohio the last year or two in terms of that soybean to corn acreage ratio.
And you're suggesting, Chris, that could be the norm going forward.
That's correct. We continue to think that soybean acreage will be more incentive, higher usage growth in soybeans than corn.
All right, let's kind of wrap up here by talking about some strategies. And I guess the first point we want to make, Chris, is that the tight margin period is still with us. We're not saying that that's gone away, but boy, we are seeing some early signs of some improvement here.
Well, that's right. And again, one of the things we look at as we observe markets, markets can take huge shocks, and the adjustment period takes time for markets to work through. Markets are determined by end users and suppliers. So we see a boom in commodity prices. We bring more land into production around the world. Eventually we get a lot of new technology. We get yields high, and we oversupply a marketplace. And then we have to go through a period of downward adjustment. In the 1980s, that took about 5 or 6 years to go through that adjustment. So we go back to think about 2014, 15, 16, 17, 18. We've had 5 years to work on discouraging some land out of production around the world, getting utilization, demand base built up. So that's a long enough time period, we might begin to think markets are getting adjusted, producers adjusted. They make major changes in their cost structure and really watch their cost per bushel closely. They watch their capital expenditures. They watch their family living expenses. And we're sure suggesting they continue to do that. But markets have had 5 to 6 years to work through this adjustment. We might begin to expect to see some turn to the better, and I think that's what we're seeing right now. Now, are we there? Can we be assured we're going back to the boom years? no, margins generally are tight in agriculture. What we should think about is the boom years were the aberration and have been as far back as we go in agriculture.
Yeah, that's a good point. We are not suggesting a return to the boom years, but we are suggesting the environment the next couple of years could be significantly more positive than what we saw the last 3 or 4
That's
years. And not that you can ignore your cost situation, that's always going to be important. The other thing, Michael, is that all the evidence suggests, and our data of looking ahead would suggest land prices and cash rents stabilizing. And maybe in some cases, maybe a little bit of uptick.
Yeah, you look at the recent surveys, and you look at some of the expectations within some of the surveys, and it looks like at a minimum that land price and cash rents could be relatively flat in 18 with perhaps some increases in 2019. And this is a very important cautionary note there. We're talking about moving towards break even from an economic profit standpoint.
From losses,
we're not talking about positive economic profits, and so I would caution people to be careful with your cash rent negotiations. Looks like we have for the last 4 or 5 years, but nevertheless, it looks like things are changing a little bit. And rather than declines in land prices, cash rents, we're looking at more flat or stabilizing land prices and cash rents. I also want to throw out kind of a caveat with respect to land prices. Land prices are driven by cash rents and interest rates of the capitalization rate. And most people expect interest rates to continue to climb. That's going to be detrimental on land prices, and will put a hold, I think, on potential land price increases in the next 2 or 3 years. And so we could see a situation where cash rents increase more than land values in the next 2 or 3 years. That's a lot different than what we saw from 2007 to 2014. Why? We're in a different environment. We're no longer in that high cash rent, low interest environment like we were in 2007, 2014. We're moving into a flat to maybe slight increase in cash rent environment with an increasing interest rate, and that's going to put a hold on or kind of a cap on how fast land prices can increase.
And that's a good point. When you look at the rise in land values, farmland values that took place on the way up, a good chunk of that was associated with the decline in long-term interest rates, and we're now on the backside of that.
And so keep that in mind when you're thinking about bidding for land here in the next year or two. That's this increase in interest rates is going to have an impact on land prices.
So we've already mentioned that current prices are probably near most people's break-evens, particularly in the high productivity soils. Chris, we've kind of suggested that if you need to catch up on old crop sales, this is an opportunity. If you haven't really started new crop pricing, this is an opportunity to lock some of those prices in, both corn and soybeans.
Well, I think you've probably heard us say better days may be here, maybe. And so again, this is always the nature as you move into maybe a change in the era that we're in, that can we be sure of that? If we return to very good yields again in the northern hemisphere this summer, then I think there's every and again, with the trade concerns that we have, if we really get into trade conflicts, we could be very discouraged from where we are here today. So I think again, caution, getting some forward pricing done. These are the profitable levels or near profitable level or near break even we have looked for. Final thing I would say is that if you have to pick a time of the year when there's more optimism in terms of market prices, it tends to be the late, early spring into the early summer. And that's when all the uncertainty in the northern hemisphere is out there about, are we going to have a good crop or not? You get to July 4th and the crop looks like another bumper crop, we won't have this same optimism. So that's what you try to do. You try to take the optimism and convert that into dollars in the pocketbook.
And I just want to point out, I think sometimes people get concerned, particularly when they think about pricing new crop, about the risk that prices could increase substantially following a sale. And so one of the things to think about in this environment is to consider the possibility, if you're pricing new crop and you're a little bit nervous about that, about the risk of prices going up and missing out on that, think about a call option strategy to match up with your sales. You can buy out-of-the-money calls that would protect you not from a modest increase in prices, but from a big rally that would allow you to capitalize on that. Out-of-the-money calls would significantly reduce your outlay for the premium on the option and make that a pretty viable strategy. So think about that as a possibility, particularly if maybe you're a little more bullish than we are today and you want to protect against that. That's an opportunity.
And we often say generally pricing the first 20, 25, 30% of anticipated new crop production. You don't have to worry too much about shortness of the ability to deliver. But if you start to push up to 50%, 60% of expected production you're pricing, then options are a really great alternative to look at, because you're not locking in bushels, you're locking in an opportunity to get a price. And if prices go much higher because of drought or a small crop, you're not locked into delivering bushels or to a set price.
Yeah, good point. Well, with that, we're going to wrap it up. We want to thank you for joining us on our webinar today and point out that our next webinar on the Outlook is coming up on July the 3rd. That will be following USDA's acreage planting report, which is released, I think, on the last day of June. So look for that on the webinar page on the Center for Commercial Agriculture website. You can sign up for that, and of course, you'll get the email reminder and a link. So we look forward to seeing you then, and want to thank you for joining us today.